Hello, everyone. It's Professor Reiko here. Today we are continuing on talking about all of our dilutive securities that will have effect on earnings per share. We'll get the earnings per share starting with the next video. This video today goes through restricted stock. So restricted stock is a little bit newer. I shouldn't say it's new, but it's just newer than stock options, and they're becoming a lot more popular. So if you go back and watch our last video went through stock options. And one of the main things we talked about stock options is that they can become worthless, meaning if the exercise price is $20 and the stock is only 15, those options are worthless because nobody's going to pay 20 for a $15 stock, right? So restricted stock is something that's a little bit more advantageous for the employees, but it's also more advantageous for the existing shareholders. So we'll talk about that right now. Okay, so restricted stock transfers shares of stock to employees, subject to an agreement that shares cannot be sold, transferred, or pledged until the vesting occurs. So there's still this service or vesting period, okay, before they can actually sell or benefit from having these shares. All right, so the major advantages are restricted stock never becomes worthless. So let's think about that for a second. We talked just a second about how stock options become worthless. Restricted stock, you don't have to pay an exercise price to buy the stock. It's given to you. You just have to wait to be able to use it. Therefore, even if the stock price goes down, there will still be value to those stock once they become unrestricted to you. Now, granted, if the company went out of business and the stock went to zero, then I guess you could argue it'd be worthless. But let's kind of not think about it in those terms right now. All right, because they'll never become worthless, we can generally give wait, like if you read here, typically they are less than half the size of stock option awards. Okay, well, what that means is this is a lot less dilution to the existing shareholders because there's not nearly as many shares being issued because they're never going to become worthless. Okay, so that's appealing to existing shareholders because their ownership level doesn't get diluted by as much. All right, and so then it better aligns employees' incentives with the company's long-term incentives because they're going to want to make sure that when that, over the time that they're working, that the stock price goes up and that it's that they can hold that, and then they have the option even to hold that stock for a number of years after the fact. All right, so we account for it using a deferred compensation account called unearned compensation. I have seen it in other books called deferred compensation. Maybe that's in the Spiceland book. All right, so deferred, unearned, you're basically saying the same thing there. Okay, and then what's going to happen, it's going to become compensation expense over the vesting period. All right, so in a way that's similar to the stock options. Remember, we expense them over the service period. That's similar here to what we're going to be doing. Okay, so unearned compensation is a contra equity account. Okay, so this is a little confusing to students because if you think about it, when we did unearned revenues and unearned things like that, they were a liability. Okay, so unearned compensation is a normal debit balance, and it's basically an unearned expense is the way to think about it. So it's a little bit confusing, but just know that it's a contra equity account, so it'll be a debit balance. All right, so there's no entry for the exercise of restricted stock because we're actually going to issue the stock on the grant date. So if you go back and look on the last video when we did the stock options, we did nothing on the grant date, and then we issued the stock when they exercised and paid for the stock. Okay, so it's a little bit different here. So let's walk through this example here. We've got a CEO is issued 2,000 shares of restricted stock when it was trading for 15. The vesting occurs after 5 years. The par value of the stock is 1. It wants the entry on the grant date and to record compensation expense over the vesting period. All right, so on the grant date, all right, so remember, we are going to issue the shares, all right, and so it says we're going to call this unearned compensation, all right, and it's going to be for the 2,000 shares of restricted stock times the current value of that stock, so the compensation 30,000, unearned compensation, I should say. All right, we are actually issuing them the 2,000 shares. It was $1 par, and then everything else goes to additional paid in capital common stock, so that's 28. All right, at the end of each year, so this is similar to what we did with stock options. We had a journal entry at the end of each year. We are going to debit compensation expense, Okay. And remember, that was total 30,000, and that's being earned over 5 years. So that's going to be 6,000. And then we're going to credit the unearned compensation account to start reducing it down to 0. All right, so if you think about this unearned account over here, so we start with 30,000 in it. And then what we're going to have over time is for 5 years, we're going to have a credit each time for 30, and then at the end it will have a 0 balance. Okay, meaning we'll have expensed all of it. All right, so that would be the journal entry. And then look at the end. Okay, at the end of the 5 years, there's no journal entry because remember we issued the stock up here. The stock's already been issued. All right, so we would be done at the end of the 5th year with these. Then the restrictions would be lifted off the CEO, and the CEO could do whatever they wanted to do with the stock. All right, so what if the CEO left? Okay, what if the CEO left early? All right, so if that's the case, they don't get to use the stock, right? Because remember, they had to work the full 5 years. So it says, what if they had left after 3 years? All right, well, what's going to happen is the stock goes back. So these two accounts that we did in the first entry are coming off the books. So we're taking those off, zeroing those out. All right, we're going to back out the compensation expense that we've already recognized, which is the 6,000 times the 3 years that have already been recognized. So that's 18,000. And then we're left with 12,000. So think about what that 12,000 will be. What's still on our books? I mean, if we stop after 3 years, we're right here, which means there's still 12,000 in that account. Actually, it'd be 12,000 on that side, debit. So we need to credit that account, the unearned compensation account, to zero that out. So that would be our last credit. So it'd clean everything up. The stock would go back to the or go back to almost being like unissued. The compensation expense would get backed out, and we would take the rest of the unearned comp off the books. Okay, so this is restricted stock, similar in some ways to stock options, but a little bit more advantageous for both the employee and for the shareholder. So they're becoming much more popular as each year goes by, as when you're comparing them to stock options. So that's just something to keep in mind there. So once again, though, remember, there's a dilutive effect because up here we issue stock, and that has a dilutive effect on earnings per share. All right, so where we're going next in this chapter is that, when you look at your book, it's pretty much broken into 2 parts. The first half kind of walks through this, and then the second half goes into earnings per share. So our next video will be on basic earnings per share, and then we'll start talking about diluted earnings per share and what that means, okay? So be sure to tune in next time. That's kind of the big focal point of this chapter is basic and diluted earnings per share. But we have to walk through all these dilutive securities first so that we know how to account for them, and then we'll move forward into earnings per share. So make sure you tune in next time. We'll get rolling on the earnings per share side of things for this chapter. Please subscribe to the channel. It does help me out. I'm glad that you guys are here listening. Hopefully it's helping a little bit, especially come test time. Make sure you share it with your friends, so hopefully it will help them too. All right, I'll see you next time.